Sarah pays the minimum on her credit card every month. Marcus pays his off in full every month. They both think they're doing the responsible thing. They're both wrong, because one of them is funding her own bank's profits and doesn't even know it. And when you actually run the numbers, what the bank is doing with her minimum payment is striking. Sarah and Marcus both have the same credit card, same $5,000 balance from a rough month, same 22% APR, same monthly statement. The only difference is what they do when the bill arrives. Sarah does what the statement tells her. Right there in the payment box, the bank prints a friendly little number called the minimum payment due. Hers is $100. She pays it. She feels responsible. She made her payment on time. No late fee, credit score safe. The bank even sends her a thank you email. Nothing about this feels concerning. Marcus stares at the same statement. He sees the $100 minimum payment box. He ignores it. He pays the full $5,000 balance. His interest charge for the month is $0. He treats the credit card like a debit card with rewards. On day one, Sarah feels like she's handling things. Marcus just feels like he paid a bill. There's nothing dramatic happening. But underneath the surface, the bank just secured years of revenue from one of them. Here's what the bank is actually doing with Sarah's account. Her minimum payment is calculated as roughly 2% of her balance, which on $5,000 comes out to about $100. Of that $100 payment, approximately $92 of it goes straight to interest. Only about $8 of it touches the actual debt. That's not a glitch. That's the design. The minimum payment is structured to keep the account current while paying down very little of the actual balance. If Sarah keeps paying only the minimum on that $5,000 balance, it will take her over 22 years to clear the debt. She'll pay roughly $7,700 in interest along the way. She borrowed $5,000. She'll pay back $12,700. The credit card company isn't earning revenue despite Sarah paying her bill. They're earning it precisely because of how she pays it. Now multiply this. The average American household carries $6,618 in credit card debt. At 22% APR, paying $132 a month takes over 11 years to clear and costs about $11,500 in pure interest. The average household pays back nearly 3 times what they originally borrowed and considers that managing their finances. The mortgage industry runs the same playbook in slow motion. On a $400,000 mortgage at 6.3%, you'll pay roughly $491,000 in pure interest over 30 years, more than the house cost. Lenders favor 30-year loans, in part because longer terms generate more interest revenue over the life of the loan. Auto loans, the same. Personal loans, the same. Student loans, the same. Every consumer debt product in America is structured to extend the time consumers spend in debt, not minimize it. If only one side were shown, that would be misleading. There are real reasons to pay slowly. If your debt is at a 0% promotional rate, dragging it out makes sense. If you have higher interest debt elsewhere, attacking that first is correct. If paying minimums frees up cash to invest at a higher return, the math can favor it. Slow payoff isn't always wrong, but the average American isn't strategically optimizing. They're paying the minimum because the box said to. The minimum payment due is the most expensive number on your entire statement. Marcus doesn't pay the minimum because he understands one thing Sarah doesn't. Lenders typically suggest payment amounts that align with their own revenue model. The real lesson isn't credit card debt. It isn't mortgages. It isn't loans. The real lesson is that following the suggested payment amount without examining how it's calculated and who benefits leaves a great deal of wealth on the table. Next time you see a minimum payment line on a statement, ask yourself one question. Who designed this number and who profits when I pay it? Because the answer that includes everything is the only answer that matters.